Welcome to the India Fintech Diaries, the only podcast focused exclusively on the Indian fintech market. I'm Elroy.
And I'm Hemant. In each episode, we dive into the latest trends, ideas, innovations, business models, and personalities that are shaping India's fintech landscape.
We also invite amazing guests who are innovators and industry players that are driving the change that is helping make financial services more modern, innovative, and inclusive in India. Come join us as we explore the changing landscape of fintech in India.
Hi everyone and welcome back to India Fintech Diaries. I'm your host Hemant and there is never a dull moment in the India Fintech land. Last few months have seen a lot of action on lending related regulations and everyone in the industry is trying to make sense of it. There are many interpretations that have been given. To cut through the financial jargon and help us through the labyrinth of lending regulations, we have with us today Mathew Chacko, CEO and founder of Spice Route Legal. Welcome to the show, Mathew.
Thank you, Heyman. Thank you for having me. That description as a CEO might not be entirely appropriate, but founder nevertheless, yes.
Cool. Matthew, you are a lawyer in a fintech land, so slightly different from normally the people that we speak to. So before we start with the discussion, we would like to understand how did you end up in this space and also what's the story behind the firm name?
Right. Okay. So firstly, I was a technology lawyer in Singapore about 10, 12, 15 years ago now. And at that time, the technology scene in Singapore in terms of startups and evolving tech was limited. So the only companies in Singapore that were rapidly, this was much before the VC boom in Singapore, that would rapidly engage with technology was the banks. So I started working with a couple of banks here and there, trying to fix their technology, trying to help them with outsourcing, software development, etc. And this was pre, Satoshi's blockchain revolution in Singapore. So ended up doing a lot of data related work with them, a lot of software related work with them. And eventually after 3-4 years, ended up having a fairly healthy portfolio of fintech work. So you can call me an accidental fintech lawyer. Went into it because I didn't have a choice. When I came back to India, I wanted to, kind of set up a firm which reflected the fact that the founders had spent a lot of time internationally, although India was the core part of our expertise. And the last time that Indian commerce dictated or demanded or commanded a pride of place in global trade was when the spice route was booming. And so we think that the next few years will show India rising in terms of global trade, and we will end up, a new modern digital spice route, hopefully. And we want to enable that, hence the name.
Very interesting, very interesting. And we are as long in India as you are. So, Matthew, now moving to the topic for the day. So, till now, Matthew, the discourse around the regulatory framework and regulations has been around RBI circulars and guidelines. That means whenever a guideline comes in or a circular comes in, that gets debated. Less a product focused discussion of saying, okay, if this is the product, what are the regulations that are pertaining to it? And how does the new regulation or a circular or a notification or a clarity from RBI, so to say, impacts that, and especially from the fintech players' point of view, because they are the new kids on the block, which are trying to make sense of the regulation and trying to deliver a more efficient service to the customers. So, is that okay with you? We take a more product view rather than a circular focus view.
Absolutely.
Awesome. So then let's start, Matthew, with the hottest one, right? Lending on PPI. I think one of the most favorite model in last couple of years for Indian BNPL players as well. So let's start with understanding what lending on PPI is and why is RBI cross about it and so many regulations about it.
Right. So conceptually, let's look at the way, before we take the product view, let's look at the way the regulator looks at it, right? For the regulator, there are 3 products involving cards, right? There are credit cards, there are debit cards, and there are PPIs. Now, each one of these have different sets of permissions that are required from the RBI. Credit cards, very stringent regime. Debit card, slightly less stringent, but equally very stringent. And PPIs, which are a slightly more relaxed form of having cash on a card, right?
Got it.
Now, of course, our absolutely brilliant series of fintechs combined the ability to directly provide a loan to a card to load PPIs, right? There was nothing in the law that technically prohibited it.
Hmm.
And therefore, it became hugely popular because I could use my card, I could just avail a loan, and my PPI would suddenly look like a credit card. Right, the moment I need an on-demand loan, I could use my PPI to kind of go and draw down that loan and immediately use the cash. Now the problem with that was that then and the regulatory problem with that was that then the PPI ended up looking exactly like a credit card.
Hmm.
There was no difference. And secondly, the validity of this entire process and whether this was leading to unnecessary consumer lending, which was risky. How are these lenders doing proper KYC if the loans are just flowing into your PPI? How are you ascertaining creditworthiness? Is there a problem with this entire system of immediate loans, right? On demand loans is something that the RBI has been grappling with for about a year or two, right?
Hmm.
And obviously, there was one statement by someone in the RBI which said this is very similar to a subprime boom, and I don't think they mean subprime in the sense of mortgages in the US, but
Mhm.
lending to people who are actually not credit worthy. And you can see multiple instances of this going wrong, with people committing suicide, with people finding it extremely difficult to pay these loans back, with collection agents behaving badly and all of that. And the RBI's recent regulations are very clear. They've taken a stick to this problem, and they've said credit cards are credit cards, PPIs are PPIs. The two are different. You cannot load a loan onto a PPI, right?
Hmm.
And that's a conceptual issue that the RBI has come up with. If you do have the time, we can discuss possible solutions that are there to continue providing the same product.
Actually, yeah, Matthew, that was my immediate next question to that, because I think these products picked up because these delivered credit at the point of consumption, which is a huge benefit to a customer. So I'm very interested in actually understanding that players like, say, a Slice or Unipay or LazyPay or anyone who is in this business, what can they do?
Okay, let's not talk about the specifics because some of them are clients, but
Okay.
here's a very simple solution, right? What the RBI says is that for policy reasons, if you are giving a loan, term credit, revolving credit, whatever it is, that loan must hit a bank account, not a
Okay.
people, right? So
Hmm.
that's the first step, right? And this is one of three, four other solutions, but the first solution, and this is the simplest. So the simplest solution for you to trigger this is for the loan to hit a bank account and for the bank account to automatically debit that money into a PPI.
Okay.
Right?
Hmm.
Using technology, we can make this not as seamless as loading a PPI, but fairly close. We don't have to go back to those days where if we were taking a loan for at the consumer point of sale, you'd have to fill in those 50 pages that Bajaj, I don't know if you remember, but Bajaj Finance used to give you those 50 pages to fill up.
Oh, I do remember. Yes.
That was, in fact, there are multiple times when and I've been fortunate to have been employed and therefore not have to necessarily, and also fortunate to not have very extravagant consumption need. But whenever
Hmm.
I went to buy a phone, I would always, I remember, want to sign up for Bajaj Finance,
Hmm.
see the amount of paperwork, and then say, boss, yeah, I'm not going to do this, right? This is
Right.
just painful. I think there is a solution. It's not going to be as seamless. It's a technology solution. It's not a legal or a regulatory solution. It's
Hmm.
to follow and comply with the RBI's requirement that the money reach the bank account and thereafter immediately move it to the PPI. Right? And that's a very simplistic solution
Right.
that I'm sure multiple people are playing around with. There are more complicated solutions around banks providing the credit, co-lending. Instead of a PPI, should we do a debit card? All of those issues have also arisen.
Hmm.
The problem is, and from an RBI perspective, and I always say this, when you're structuring products for fintech, try not to look at the exact language of the regulation and try to play around with the RBI. try and identify why the RBI is doing something and solve for it using technology. And I've been a technology lawyer for 20 years. Technology in 99.9% of the time for legitimate use cases will provide a solution that is consistent with the RBI's aim of keeping a track of these sectors, right?
Got it.
Because written into technology is accountability, right? Because you can track almost everything,
Yep.
right? So my general advice to the market is try and figure out what the RBI want. And I can give you one example, right? And then from there, try and work out a solution. I don't know if you remember this, but there was a huge controversy about a year ago about virtual private accounts,
Hmm.
right? Are they payment aggregators or not? And I remember reading the regulations on payment aggregators and saying virtual private accounts are not payment aggregators because they're not fulfilling settlement transactions in the course of a payment.
Hmm.
And I remember sitting down with someone from the RBI and someone who was formerly with the RBI and saying, sir, can we do, and very senior of them, and says, can we do this? And he looked at me and said, Matthew, you've been a lawyer for a long time and you've been harassing me about the RBI for 19 years. Why don't you try and see what the RBI is trying to do? So I said, okay. The RBI is trying to make sure that small companies that do not have net worth and credentials and all of that are not holding your money because of settlement risks. Let's say if the provider of virtual private accounts goes bankrupt one day, will the
Right.
consumer lose the money? That's what the RBI is trying to solve.
Hmm.
Now, if that is so, then there is every policy reason to require a virtual private account provider to become a payment aggregator, because then there are requirements around
Correct.
capitalization.
Yeah.
And put from that perspective, stop thinking like a lawyer, start thinking like someone who's got to keep the integrity of the financial sector market, and
Hmm.
then start structuring solutions around digital lending, right? Because I think you and I both agree that digital lending is brilliant solution for many use cases. But I think you and I can also probably agree, and please tell me if you disagree, that it has also been a case of significant misuse in the last 1 or 2 years.
True. That is true. Yes.
And RBI is just stepping in, and maybe it'll fine tune the regulation. There are areas in the new DL regulations that are a bit worrisome, and that whitelist that the Honorable Finance Minister announced is also slightly worrisome.
Hmm.
But there are ways you can tinker it and make it work for the industry. For example, Nirmala Sitaram they announced a whitelist. My request to the government would be, can we make it a blacklist? Right?
Hmm.
Let's actively black out and ban apps that are badly behaving. But let's not ask and create like a regulatory.
Yeah, that will just create red tape, which we're actually trying to get away from, because that becomes a roadblock for a positive player in the market to even go and start serving customers. True.
Correct. And also, it will stymie the smallest, most innovative players. And those are the
Correct.
ones the government wants to improve. Like, imagine when, and we can talk of one client, I think. Imagine if price was really small. If
Hmm.
you did all these regulations, just their legal fees would kill them, right? Okay,
True.
forget everything else. Now they're big enough, they can have an army of lawyers, and they do.
Hmm.
And so we want future slices that are even more innovative than Slice to come. And Slice is a brilliant company, right? And
Right.
even more innovative than Slice to come out of the market and compete with Slice, forcing Slice to improve. And
Hmm.
that's one thing that I think the government, that's the only complaint I have. I think the RBI is brilliant as a regulator. In fact, in India, where I wish all the other regulators, tax, AO, all of them were
Hmm.
as proactive as the RBI was. But I think we still need to move out of our license Raj mentality.
Right. Absolutely. That's the key point. And I think, Matthew, that's a very good segue to the next conversation that we wanted to have on the overall, the working group digital lending implementation. And then now on the 2nd September, the guideline on digital lending. But before we go there, I had this on the BNPL side question remaining on the 15-day format of BNPL players. So with the new format in place, a lot of these 15-day ones said that we are not even credit players or lending players. Does it impact them as well? and even they would have to now go through the traditional options that you just spoke about, or they can continue operating the way they had been.
So that, I think, is an unresolved solution that we'll need RBI clarification from. We're not very clear on what to do with the 15-day BNPL.
Got it. Got it. Got it.
I'm able to understand that clarifications will be on the way.
Perfect. Perfect. Yeah, because that question remained when we had this conversation multiple times with now you and with other industry players as well. So now let's just then move to the new guideline for digital lending. And if we can go through the key elements of it that will have an impact on a fintech player, and what are the options for them to ensure that they are in line with not only the wordings, but the exactly as you said, the spirit of the regulation.
Right. Yeah. So that's the one thing that the RBI keeps harping on, right? Not the letter of the law, but the spirit of the law. Even multiple times when our clients have been, requested to answer certain questions by the RBI, there was always a very sharp spirit of the law question. What are the primary elements which are the underlying conceptual basis of the digital lending guidelines? One of which is the RBI likes on balance sheet transactions, right? The RBI does not want you to provide unnecessary levels of credit enhancements whereby the risk is transferred from an NBFC to a, for the absence of a better word, startup funded by venture capital money, right? So the underlying principle is all the RBI's NBFC regulations are aimed at making sure that an NBFC takes responsible, coherent steps to assess creditworthiness of an individual and thereby give loan. If a second party or a third party to the transaction was to come in and take over the risk associated with a loan, the question that probably any regulator will ask is, what incentive is there for an NBFC to be careful about lending, right? And so what the RBI has said is, I want the NBFC to take the risk, or at least a significant portion of the risk, right? So that's one. The second thing that the RBI has come out with and very clearly said is, we want there to be accountability for the NBFC or other regulated entities, accountability for the actions of the digital lender, accountability for the actions of the loan service provider, and especially accountability for the actions of collection agents, right? And I can give you a very personal example of something that happened to me about 2 months ago. So I spent about 10 years outside India, right? And just before I went outside India, I thought I'd cancelled all my credit cards and I'd done all my debit cards and all of that. But it appears that there was one debit card with some 100 or 115 rupees. This was in 2007, 100 or 115 rupees pending on that credit card. And which then, the card got cancelled. But that 115 rupees, by virtue of, the innovative interest methods they have, eventually over the course of 10 years became 1,800 and got transferred to a asset reconstruction company that is owned by Kotak, right? So the collection agent called me and said, can you pay? We'll settle off. This was about 6 to 7 months ago, 12 years after the loan. So I said, okay, I'm so sorry. I could not, I did not know that I had this outstanding. Of course, I'll pay. And then I said, I'll pay in the next 2 days because they wanted me to go down to the Kotak branch and pay or something like that. Or my digital payments apparatus was not working. So they said, yeah, can you just go to Kotak and pay? And I already had a relationship with Kotak. So I said, okay, I'll come down and pay. And the day that I was supposed to come, I had a really important meeting, ironically, for a bank that competes with Kotak in Bombay. So I went to Bombay and I, the collection agent called and said, Matt, have you paid? And I said, no, I haven't paid. I'm really sorry. I'm in Bombay. So collection agent started getting a little aggressive. And he started getting a little aggressive. This is a call from their Delhi branch. They started getting a little aggressive with me and started speaking to me in slightly colloquial Hindi. So my Hindi, as most South Indians, is derived from Bollywood movies, thoda sa formal, thoda sa colory. So I said, guys, I don't speak Hindi very well. Can you speak to me in English? Then the collection agent started, you are an Indian, you can't speak Hindi, right? And in Hindi. So then I explained to the collection, boss, I have, about 10,000 times the amount of money that I, or at least my math is bad, but over 1,800 times the amount of money that I owe in Kotaka bank account. And I willingly
Right.
said I'm going to make the payment. But if you think you're going to aggressively push, and I've apologized for it, if you think you're going to aggressively yell and shout at me and you're going to make a payment, I'm not going to do that. And then we'll see you in court, right? You picked a fight with someone who unfortunately has access to justice. So I'll see you in court. And then I got about 50 calls from them, each one more aggressive than the other, right?
Oh,
So this points to the problem that the RBI is trying to solve. Collection agents, are not under an obligation of responsibility. Think they can arm twist people into, and this is someone who has access to justice, right? Imagine if I didn't have
right.
access to justice and I was in a tier 4 city and I wasn't educated, I would have probably gotten really scared by the tone and tenor of these collection agents, right?
Right.
So that's something that the RBI has taken a hammer upon, and it is very clear that even if the collection agency is outsourced to, say, a DL or a loan service provider or both, the NBFC will have to be accountable for all their actions. That's the second. The
Understood.
third
Mhm.
level of checks is around data security that they've come in with. And the NBFC is responsible for ensuring that your digital lender has, for the ease of a better word, let's say privacy by design incorporated into their architecture. In fact, right now we've been sitting and designing privacy, redesigning privacy and compliance protocols for these NBFCs. In fact, we have been telling these digital lenders for over 2 or 3 years to get privacy by design implemented in India, because even
Mm.
if it's not mandatory now, within 1 year, 2 years, whenever that data bill comes out, it will be mandatory. So please prepare. But there's been reluctance till now, this one regulation, and we've got multiple digital lenders coming to us and agreeing to do this. So all these three are the core fundamental principles that underlie the digital lending guidelines. A related point
Got it.
that you must think of, since you're looking at it from a product perspective, is
Mhm.
FLDG debt, is class
Right.
default guarantee debt. And the regulations are very clear. Credit enhancements right now in the form of a simpliciter FLDG or some of these weird non-convertible debenture structures that these NBFCs have been using, in the original shape and form, is probably not promising. However, RBI has
Mm.
pointed PHSA out and said, follow the securitization guidelines and we'll be fine. So
Got it.
all the
Got it.
NBFCs will now have to restructure their FLDGs, or they're not even, can't be FLDGs anymore, but restructure their guarantee systems and their credit enhancement systems using the securitization guidelines, which I thought was a superb move by the RBI. Little bit more clarity on how to use it would be appreciated. But brilliant move. They
Right.
have banned something, and they have also pointed out to a regulatorily consistent way in which you can achieve similar commercial aims without many of the risks associated with the present structures.
Got it. Got it. So, Matthew, actually, I had three follow-up questions on the details that you just shared, but looks like today you are predicting some of my questions already. So, the first one was FLDG, but you just answered that. The second one is you spoke about that all the disbursals and collections and everything should only happen to a bank account between the registered entity and the borrower. Now, where does that leave a payment aggregator? Because a lot of NBFCs and companies were using payment aggregator to collect the payments aggregated at a single place and then deposit it. So, is there some clarity emerging on that as well?
There is an exception to the general rule that if you are a regulated entity and you have some statutory rights to keep the money,
Hmm.
then or to provide these services, then the DL guidelines will not negatively impact you,
Got
right?
it.
My view personally, and it hasn't played out yet, is
Mhm.
that you are a PA player and your action is a falls within the regulatory actions that are permissible for a payment aggregator. None of the external regulations, bars in the digital lending guidelines will affect you.
And then, Matthew, the last question pertaining to that I had was a lot of actually, there is a saying in the fintech world now that all revenue or profitability roads lead to lending as a product. Now, because a lot of companies were using lending to maybe get some transaction data, use that to do upsell or cross sell, earn commissions on it, and there are other ways of it. Now that RBI has, as you said, clearly come out with the privacy bit as well, that all NBFC need to have privacy by design. So will that reduce a lot of LSPs to just that, which is basically a DSA kind, digital DSA, where they can sell and earn commission, but nothing over and above that?
So I was really, really happy with the approach taken by the RBI on data, in the
Hmm.
sense that their intent was only to let the consumer control the use of their data. They have
Right.
not made any further regulations or restrictions on use of data, other than the fact that you have to display how you are using the data to a consumer. You have to make it very clear that these are the ways in which the data is being transferred, processed, analyzed, all of that. And you have to give them the right to delete all that data, access it, correct it, and all. As long as we, within these guardrails that the RBI has imposed, as long as we take the permission of the consumer in a effective and implementable and clear way for whatever other actions that we want to do,
Mhm.
barring regulatory further clarification. So the RBI comes
Right.
and says you can't. But as long as the RBI doesn't change the regulations at this time, there is room to take consent of the data subject and achieve most commercial aims. Can I take all the data and sell it in the black market? Absolutely not. Not only the RBI,
Mhm.
this will also come up, as they should, right?
Right, of course.
And it's already available. Like, you'll be shocked at the number of people who tell me Aadhaar card data is available in markets, in specified places in India. So I mean, I of course have absolutely no idea. But if data is available publicly at such a large scale, there is obviously a problem with our data laws. And I think in the absence of that bill, because we're still debating how to kind of have a comprehensive data bill, the RBI has kind of stepped in and done what it can and what it should, right?
Mm.
Will
Right.
this change when the new bill comes in? Oh, absolutely. But unless, of course, the new bill says that, this is in addition to the RBI regulations.
Right.
But even if it does, this is a positive first step. I don't think the data regulations are going to kill the industry. I think the data regulations are only going to require Indian financial services and technology service providers to have a semblance of data governance and a respect for the fact that this data is not theirs, but it's actually the consumer's.
Got it. Got
So,
it.
if one could clap, I think the biggest positive take back from the DL regulations is the data rule. I only wish they'd made it applicable like one set of data rules for everyone, right? DL,
Mm.
is NBFCs. If you could just have, a charter of consumer rights that the RBI imposes on the financial services sector, and maybe encourages SEBI, PFRDA, and others to also adopt it. I think that would be a fabulous solution for our data problem.
Now, Matthew, imagine if I am, say, a fintech NBFC founder and I want to do consumption at the point of consumption credit. So, today, at least right now, it seems that I have no access to a payment rail, which is, say, for example, a credit card or a card mode, or UPI via credit on UPI because it is still limited to, say, a RuPay. And when it comes to credit card, RBI says that an NBFC can opt for it, but right now we only have Bank of Baroda and SBI cards, which can actually issue credit card as of today. So then, for each of these product, is it feasible for an NBFC to go ahead and do it, say, profitably, especially on the credit on UPI? Because I think there's limited clarity on how it will pan out.
Yeah, so right now there is regulatory lack of clarity in this space. We'll just have to wait to see how this plays out, right?
Hmm.
I know there are 3, 4 solutions that even we proposed to a couple of clients. But even when we propose it, we're very, very clear that that particular problem is subject to RBI clarifications. There are risks in everything that I think is a solution that is being proposed in the market. But I generally have faith in the RBI, and this is contrary to what most of my peers in the profession say. Yes, the RBI sometimes overreaches, but it's a regulator. Look at the PA guidelines, right? They came out
Hmm.
with a set of guidelines, and they issued multiple clarifications to not kill the industry. Even
Right.
when some companies did not fulfill the net worth criteria that was imposed as of March 30th, 2020, the RBI came,
Mhm.
extended the deadline, put in a fresh date. It's not a regulator that is not listening. So I wouldn't be surprised if the regulator listens very carefully and tries and solves for the and enacts systems which will allow you to provide last mile credit, consumer credit, all the way down to a debit credit or a BPI. Have a system for approvals for all of that. I think that's coming. You're right. At
Hmm.
this particular point, I think there is a little bit of gray area, and every solution that is prevailing in the market has regulatory risks. One solution could be to approach the RBI. The other thing that I found is you approach them with genuine questions, they respond to you. So the other option
Hmm.
that maybe a DLAI or a payments industry association, either of those could approach the RBI for clarifications in this regard. I suspect it will come,
Hmm.
right? But you're right.
Yeah.
At this point, every potential solution has risks.
Understood. In fact, Matthew, I was just going through Twitter. Of course, there are a few really brilliant fintech founders having discussion on this topic. One solution I saw, and I think this was Sandeep, I don't remember his firm's name, but spoke about that as per regulation, existing regulations, you can disburse a loan which has no end use confirmation to a overdraft account. And as per UPI 2.0, overdraft UPI can be funded through your overdraft account. So that means in an indirect way, maybe you can issue the consumption finance on UPI via overdraft account too. But I've yet not seen NBFCs getting access to open an overdraft account. Maybe it could be via the bank. But that was one interesting take on it that I saw.
Yeah, Jugaad runs through our blood, right?
Yeah, that is very true.
Remember, in both the PA cases and the DL cases, the RBI has been very, very clear. Please comply with the letter and the spirit.
Mhm.
I would suggest that we don't get cute with the structures. You've forgotten, you've left one small loophole, and I'm going to exploit that. It's a temporary solution because the
Correct.
RBI will get wind of it. It will ban this. It may not. It may kind of bring this up. Here's something that's happened to a client of mine. I can't mention it, right?
Mhm.
A client made a small mistake, got pulled up by the RBI for a small mistake. But when we went to the RBI to try and fix it, the RBI, the regulator, was like, "Yeah, but previously you have done 1, 2, 3, 4 also, right?" Which is correct. Those 1, 2, 3, 4 that we've done were all exactly these kind of solutions, where the
Right.
regulations did not specify OD, you go and put it in
Mm.
an account. All of that happened. So we were like, the only legitimate response at that particular point was to say, "We are sorry. We have stopped doing all those cute things that we used to do. We will also
Mm.
undertake to conform to the spirit and the letter." But the RBI has a long memory; it remembers, right?
Right.
So rushing into this, because also it's also very, very clear on day one that we are going to have very detailed regulations around payments and lending and data from the RBI in the future, like very nuanced regulations, right? And you are probably going to have a whitelist, blacklist, whatever list is going to come. You might have a registration form, all of that, right? If that is the future that you are looking at, and if you are a responsible actor, stop taking shortcuts to regulatory issues. Either solve it with proper tech, right? You can create technology to transfer in a fairly seamless manner money from one account to another account to a PPI, all of that, right?
Right.
To the
Mhm.
flick of a button or a swiping one way or any of those things, right?
Yeah.
So uh, go build that. Do not, and this is kind of going to insult all of us fintech lawyers. Do not think that your lawyer is a technology product engineer.
Hmm.
A lawyer can do product structuring to the extent of the regulation. Do not use loopholes and ask your lawyers to find solutions. ask your technologist to find solutions,
Right.
and then ask your lawyer to match those solutions to the regulations. If you come to me and say, can you find a solution for this, the only thing I can do is figure out the regulations, look at my understanding of the market and the technology, and say these are the 5 things that you can do. On the other hand, if you go to your technology service provider and say, you please talk to my lawyer about solutioning for
Hmm.
that, put the two heads together and solve it. Do not go to one or the other. Because the other problem I've noticed is sometimes you just go to the technologist and he comes up with a solution which is a total misunderstanding of the rig.
Right.
Unfortunately, you need both sitting together, yelling at each other for 2-3 days to figure out how to solve these issues. But we've done that in a couple of instances, and we know that this can be solved using technology. Slightly less seamless than otherwise, but it can be solved using technology. If I go any further, I suspect I'll be violating attorney-client privilege. But
No
it's a
problem.
solvable problem.
True, true. And Matthew, I think this has been a brilliant conversation. And what I get a feeling from what has been happening for past few months and the way you have explained is it is good for the entire industry because the industry is moving towards maturity now. Instead of finding loopholes and finding gaps and regulatory arbitrage, we are moving where the ones which are operating in the right manner, in fact, will get more credibility and more faith and trust from the clients or customers and helping them grow as well. So I really enjoyed this conversation, Matthew, and I'm very sure our listeners will enjoy that as well. Now, Matthew, we have raised some very, very interesting points. And in case our listeners, who are mostly, say, fintech founders or people are operating in the industry, want to get in touch with you or your firm, what will be the best way to do that?
Oh, just Google my name, all my contact details, email, phone number, everything's available. These days, it's been a little bit of a mess because that means banks offering loans and credit cards are the ones who primarily call me. But details are available. You can ideally, the way to get in touch with is email. I'll be happy to answer questions, follow up questions that you have, or any of these. So that's one. But yeah, I mean, I'm available. And the other good news is, being a small group of fintech lawyers in the country, most people tend to know. It's a really small world, right? So most people tend
Yeah.
to know. Like how when you reached out and I said, oh, you work for Zeta, and we had a longish conversation about my very positive experiences with Zeta. So it's a very, very small world.
True, true, true. Yeah, we are also missing Elroy today, the my co-host that you spoke to. But the good thing is, good or for our profession. I'm in my day job. I'm a consultant, right? So RBI regulations are creating a lot of work for both the lawyers and the consultant as well. I'll also include the details that you shared on our show notes so that our listeners can reach out to you. And thanks again for coming on the show and spending time with us.
I'd just like to leave you with a thought. When I was a young lawyer, I was working in a very large law firm in Delhi, and this was a time when Delhi police was trying to become more people friendly, and their slogan was "Help us to help you." Uh,
Mhm.
and I think slowly that is also the RBI's approach. I think if the fintechs and the startups and the NBFCs jointly point out pain points that they have in the system and help the RBI to create systems to help you, I think very easily an absolutely proactive, observant regulator could help iron out the few remaining wrinkles in the regulatory system.
Awesome. So on that very positive note, we are closing the podcast for today. That's it from India Fintech Diaries for this week. Do log on to our website indiafintechdiaries.com for exclusive content. We also cover weekly fintech deep dives in our Substack newsletter. So do subscribe. Until next time, mask on and stay safe.